It sounds unbelievable at first glance, a quiet move, barely covered in mainstream headlines, yet potentially worth up to $146 billion. No dramatic press conferences, no global alarm bells, just a series of decisions, agreements, and geopolitical shifts that, when pieced together, reveal something much bigger unfolding beneath the surface. To understand what's really going on, you have to zoom out and look at the broader landscape. Over the past few years, global supply chains have been reshaping themselves. Countries are scrambling to secure resources, energy independence has become a strategic priority, and alliances are shifting in subtle but powerful ways. What happened between Hungary and Canada fits right into this larger transformation, but almost nobody is connecting the dots. It starts with Hungary's evolving position within Europe. Once seen as a mid-sized player with limited global influence, Hungary has been quietly leveraging its geographic and political position to punch above its weight. By strengthening ties with key partners and making calculated economic decisions, it has managed to influence resource flows, investment routes, and industrial priorities in ways that ripple far beyond its borders. At the same time, Canada has been sitting on something incredibly valuable: vast reserves of critical minerals. We're talking about lithium, cobalt, nickel, rare earth elements, the essential building blocks of modern technology. These materials power electric vehicles, renewable energy systems, advanced electronics, and defense technologies. In the 21st century, they are as strategically important as oil was in the 20th. Now here's where things get interesting. Europe, including Hungary, has been racing to reduce its dependence on certain global suppliers for these critical materials. Supply chain vulnerabilities have become painfully obvious, and governments are under pressure to secure stable, reliable sources. Hungary, despite not being a major mining powerhouse itself, has positioned itself as a key hub for processing and manufacturing, especially in the battery and electric vehicle sectors. Major investments have poured into Hungary for battery plants and industrial infrastructure. These facilities don't just appear out of nowhere. They require a steady and massive supply of raw materials, and that's where Canada enters the picture. Canada has been actively seeking partners to develop and export its mineral wealth. But instead of simply shipping raw materials, there's been a push toward building integrated supply chains. Partnerships that go beyond extraction and into processing, manufacturing, and technology sharing. So, when Hungary made moves to deepen cooperation with countries supplying these resources, including regulatory shifts, investment incentives, and long-term industrial agreements, it effectively opened a major gateway. Canadian companies and resources suddenly found a more direct, strategically valuable path into the European market. This is not just about trade in the traditional sense, it's about positioning within a future-defining industry. Electric vehicles alone are projected to dominate global transportation in the coming decades, and the battery supply chain is at the heart of that transition. Whoever controls the flow of materials and production capacity holds enormous economic power. The $146 billion gift isn't a literal check being handed over. It's the estimated long-term value of opportunities created: contracts, investments, infrastructure development, and market access that could benefit Canadian industries for years, even decades. By creating favorable conditions and acting as a hub, Hungary essentially amplified Canada's ability to tap into European demand. And the reason it went largely unnoticed is because it didn't happen in one single moment. There was no dramatic signing ceremony labeled as a historic transfer of wealth. Instead, it unfolded through policy adjustments, investment deals, corporate expansions, and strategic alignment over time. Another layer to this story involves geopolitics. As tensions rise globally, countries are becoming more cautious about who they rely on for critical resources. Canada is seen as a stable, reliable partner with strong environmental and regulatory standards. That makes it an attractive supplier for Europe, which is trying to balance economic needs with political and ethical considerations. Hungary's role in facilitating this connection becomes even more significant in that context. By positioning itself as a bridge, not just geographically, but economically, it has helped unlock value that might otherwise have remained untapped or delayed. There's also the industrial domino effect. When large-scale manufacturing facilities are established, they don't operate in isolation. They create ecosystems. Suppliers, logistics companies, research institutions, and service providers all cluster around these hubs. This multiplies the economic impact far beyond the initial investment. So when Canadian resources flow into Hungarian-based production systems that serve the broader European market, the benefits cascade outward. Canadian companies gain stable demand, long-term contracts, and deeper integration into global supply chains. That's where the massive valuation comes from. Not a single transaction, but a sustained flow of economic activity. Critics might argue that calling it a gift is misleading. After all, Hungary is also benefiting enormously from these arrangements. It's attracting investment, creating jobs, and strengthening its industrial base. And that's true. This is not a one-sided deal in the traditional sense, but the framing comes from the idea that Hungary's strategic choices unintentionally, or perhaps indirectly, unlocked disproportionate advantages for Canada. By building infrastructure and demand that relies on imported materials, it effectively boosted the value and importance of Canada's natural resources on the global stage. What makes this even more fascinating is how it reflects a broader shift in how economic power is created. It's no longer just about who has resources or who has factories. It's about how countries connect the dots between them, how they build networks, partnerships, and systems that generate value over time. In this case, Hungary didn't need to own vast mineral reserves to play a pivotal role. It leveraged its position, attracted the right investments, and aligned itself with emerging industries. Canada, on the other hand, didn't need to build massive new markets from scratch. It tapped into an existing and growing ecosystem. The result is a kind of synergy that, when quantified over the long term, reaches staggering numbers. And yet, because it lacks the drama of traditional headlines, no conflict, no crisis, no sudden announcement, it slips under the radar. It's the kind of story that only becomes obvious when you step back and connect multiple threads across economics, politics, and industry. There's also a lesson here about how modern global influence works. It's not always the biggest or loudest moves that matter most. Sometimes it's the quiet, strategic decisions, the ones that reshape systems rather than grabbing attention, that end up having the largest impact. For Canada, this situation highlights the growing importance of its natural resources in a world transitioning toward clean energy and advanced technology. For Hungary, it demonstrates how a country can elevate its role in the global economy by focusing on key industries and building the right partnerships. And for everyone else, it's a reminder that the global economy is constantly evolving in ways that aren't always immediately visible. What looks like a routine investment or policy change today can turn into a multi-billion-dollar shift tomorrow. So while the phrase $146 billion gift might sound sensational, it captures something real: the scale of opportunity created through a series of interconnected decisions. Not a single moment, but a chain reaction. And chances are, similar stories are unfolding right now in other parts of the world, just as quietly, just as powerfully, waiting to be noticed only after their full impact becomes impossible to ignore. And if you keep following this thread, the implications stretch even further than just minerals and manufacturing. What's emerging is a new kind of economic architecture, one where influence is built through interdependence rather than dominance. Countries are no longer just competing, they are embedding themselves into each other's success in ways that make separation costly and cooperation essential. In this evolving system, timing becomes everything. Canada didn't suddenly discover its mineral wealth, it has always been there. What changed is the global urgency around securing those materials. Hungary didn't invent industrial demand overnight either. It anticipated where demand was heading and positioned itself early. When those two trajectories intersected, the result wasn't just beneficial, it was explosive in scale. There's also a financial dimension that often gets overlooked. Large institutional investors, pension funds, and sovereign wealth funds are constantly searching for stable, long-term opportunities. Projects tied to critical minerals and clean energy infrastructure check all the right boxes. They're essential, future-focused, and backed by government support. As Hungary built out its industrial base, it didn't just attract companies, it attracted capital. And that capital, in turn, needed reliable supply chains, further reinforcing Canada's position. Another layer is technological collaboration. Supplying raw materials is only one part of the equation. Increasingly, countries are looking to move up the value chain, investing in research, refining processes, and advanced manufacturing techniques. Partnerships between Canadian resource firms and European tech and engineering sectors could accelerate innovation in battery efficiency, recycling methods, and alternative materials. That means the real value might not even be fully captured in the initial $146 billion estimate. If breakthroughs emerge from these collaborations, the economic impact could multiply far beyond what current projections suggest. Entire new industries could spin off from these partnerships, creating additional layers of growth that are difficult to quantify today. Then there's the political ripple effect. As economic ties deepen, so do diplomatic relationships. Trade agreements become more strategic, policy alignment becomes more important, and countries begin to coordinate more closely on global issues. Canada's growing importance to Europe's industrial future could translate into stronger influence in international negotiations, from climate policy to trade regulations. Hungary, meanwhile, strengthens its leverage within Europe itself. By becoming a critical node in a high-demand supply chain, it gains a stronger voice in regional decision-making. Other European nations, reliant on the same industrial ecosystem, have a vested interest in maintaining stability and cooperation with Hungary. But this kind of interconnected system also comes with risks. The more integrated supply chains become, the more vulnerable they are to disruption. Political instability, regulatory changes, or economic downturns in one part of the chain can ripple outward quickly. That means both Canada and Hungary will need to balance opportunity with resilience, diversifying partnerships while maintaining the core relationship that's driving this growth. There's also increasing scrutiny around environmental and social impact. Mining, processing, and large-scale manufacturing all come with challenges. As demand accelerates, so does pressure to ensure that these industries operate sustainably. Canada, in particular, faces expectations to maintain high environmental standards, while Hungary must manage the local impact of rapid industrial expansion. Public perception will play a role as well. As these projects grow in visibility, they may attract both support and criticism. Governments and companies will need to communicate clearly about benefits, risks, and long-term plans to maintain trust and avoid backlash that could slow progress. Meanwhile, other countries are watching closely. Success rarely goes unnoticed for long. If this model proves effective, it's likely that similar partnerships will begin to form elsewhere. Nations with resource wealth will look for industrial partners, and manufacturing hubs will seek secure supply lines. The result could be a wave of new alliances that reshape the global economic map. In that sense, what started as a quiet alignment between Hungary and Canada could become a blueprint. Not a one-off gutnay, but part of a broader trend toward tightly integrated, cross-border economic ecosystems built around the industries of the future. And perhaps the most striking part of all this is how invisible it remains to the average observer. There are no viral moments, no dramatic turning points, just a steady accumulation of decisions that, together, shift billions of dollars and redefine strategic priorities. By the time the full impact is widely recognized, the foundation will already be set. Contracts will be locked in, infrastructure will be built, and supply chains will be deeply embedded. At that point, it won't feel like a sudden windfall. It will feel inevitable, as if it was always meant to unfold this way. But it wasn't inevitable. It was the result of foresight, positioning, and a willingness to act before the spotlight arrived. And that's what makes this story so compelling. Not just the scale of the numbers, but the subtlety of how they came into existence, quietly, gradually, and almost entirely unnoticed until now.